attended the conference before, you know that I have spoken on venture capital, and there was a tape that was prepared a couple years ago on venture capital, and I'm certainly not going to revisit what it is that was on tape of those of you who were there at the time. What I want to do is kind of bring it up to date, is kind of look at where that left off and kind of move it further. I think some things have happened in the whole venture capital area, venture capital and banking, as a matter of fact, that I can't say that I was surprised, but some things have happened that I think that we need to be quite aware of, because there have been some major changes, and some changes I think that have sort of have shocked me, but also has kind of changed the way in which venture capital firms and banks do business. And I wish I could say some real positive things about that, but I think those changes have really hurt not just minority business people, but the small business community. So I'll talk about some of those, and then near the end, and I'll talk about where I think we can go and where I think some of the solutions are, and then leave some time so that you can ask some questions. When we look at kind of venture capital firms and say, what is a venture capital firm? What is it that they do? The venture capital firms, they invest in and make loans to expanding businesses. I was at a conference about 6 or 7 months ago, and the questions that were asked about financing seemed not to fit into any category, because when the venture capital people spoke and when the bankers spoke, there was a big gap there where most of the people had a need, and it did not seem to be a place where that need could be fulfilled. And I think that that's really what exists today. So the venture capital firms are those that are looking for expanding businesses. And a lot of those smaller business people are looking basically for what they might consider a venture capital. And they say, well, you're a venture capital firm, so it seems to me that you should want to finance venture capital. And venture capital firms may come back and say, yeah, but we really don't mean that. We don't really want to finance startups. You know, people are very small, and they say, well, I'm not a startup. I've been in business 2 or 3 years. But when they begin to analyze your company and look at the sales and management, and it's a one-person operation, and you want to take it from here to here, they say, we look at that as venture capital, as startup capital, and that's not something we really want to do. We want to look for companies that are in the second or third stage, and that's what we really want to look to. He said, well, maybe you're not the right place for me. I'll go to the banks. Now, generally, it happens the other way. You go to the banks, and then when the banks say no, then you find other sources and you begin to look to them. Well, let me go to a bank and say, well, what do banks do? And unfortunately, the banks now are providing conservative loans to those who don't need the money. So you go to a bank and you say, I have a need. And the bank begins to look at things and say, well, I don't think it fits, and we really can't help you. You need to begin to look for startup capital. Where do you go? Well, when you go to the majority community, they say, well, you go to your parents, you go to your friends, you go to your relatives, and you get the money from them to start your company. You say, well, I need about $50,000 or so. Go to your family and friends. We can't do that. Our family and friends don't have $50,000 to invest in our businesses. So again, and when they talk to the majority community, a lot of them do. I have a friend of mine, or associate of mine, that's in a group called Young Presidents Organization, and they're presidents of CEOs of companies that you have to do at least $4 million and have at least 100 employees and under 50 years of age in order to get into that organization. So he needed some additional financing. And so what did he do? He said that he went to Family Trust. And he came to me and he said, Mel, that's what you really need to do. He said, you need some funds. He said, you need to go to Family Trust and get them to invest. And he raised about $5 million from Family Trust. I didn't want to laugh at him, but you can imagine me going to Family Trust, people that I know of, which don't exist, to try to raise $5 million to take my business from one level to the other. So sometimes those things that are open to the greater community does not exist in our community. So what I have found, and to my surprise, the shock part of it, is that I serve on a major bank board in Baltimore. It's the 5th largest bank in the state of Maryland. And the involvement in that bank, I mean, I've learned from the board meetings and things that have happened within our bank. But secondly, I began to then notice articles in the paper. So whenever there's an article in either Wall Street Journal or New York Times or the Washington Times, one of the papers that I normally read, or the Post, and I see something on banking, I stop and I began to read it. So I really got a better feel for what's happening in banking and some of the problems that exist for the small minority community. And the banks, of course, are asking for much more than before: solid collateral. They want profitable companies. They're looking for people, companies in the second and third stage of financing. They will look for companies that are consolidating their debt, profitable companies that are trying to consolidate their debt so that they can operate much more efficiently. And then you have this whole area on the mortgage side. I find that banks now, even large banks, are seeking mortgages. And at first that was kind of perplexing to me, because I said, why would they do that? I mean, you get these mortgages, someone has a 30-year mortgage, a 20-year mortgage at a fixed rate. Since most of them are fixed rates, and that interest rate may be now 8%, 8.25%, 8.5%, 8.75%, 8.625, and say, why would you do that? Because it's so difficult to determine where they're going to go. So why would banks be interested in doing that? And what I found is that what these banks are doing is they're selling off their servicing rights and selling off those mortgages. So they're finding a way to make this particular money, so that you, for example, get a mortgage, and you look at your particular mortgage and you say, well, First Bank of Maryland is holding my mortgage. And then you get a letter in the mail that says that that mortgage has been sold to Citibank of New York or some other insurance company or something. And some people don't like it, and they may complain. But what most banks do, I know what our bank does, is that at the time in which you apply for a mortgage, they notify you right up front that we may sell off our servicing rights or sell this mortgage to someone else. So what happens is that there are companies on Wall Street that won't buy an individual mortgage, but they'll buy thousands of mortgages at a time. So these banks are sending all of these particular mortgages that they're selling to them, and I don't understand it well enough to know what they do, but they are being able to take this and try to offset these interest increases and decreases because of the volume that they have. And you may have read some things about derivatives, which is a really complex process. But what happens with these derivatives, basically, it's just a way in which you're trying to offset the interest, the flexibility of this interest, up and down interest rates, and you're trying to really bet on whether or not the interest is going to go up or not. And then the many vehicles that are set up in order to be able to offset. And derivatives are just a number of, and that's just not one thing. Derivatives are part of that whole process. That these people are sitting there trying to say, how can I minimize my risk as it relates to interest? And that's a whole part of that process. So it becomes pretty complex, but the thing that's important about that is the banks see this as a way of making additional money by being able to grab these mortgages now, going after these mortgages, and then selling those mortgages off. So they don't have to wait 30 years at 12% each month for 30 years in order to recapture the amount of money that they have lent plus the interest. So they're looking at that as doing something. Say, but banks make money if I borrow the money from them, and then I have to repay them at a certain rate. And they say, and banks will say, well, yeah, we used to do that. He said, but we can make more money, and you may have noticed this, in the stock market. So what banks now are having huge investment departments. So they can make more money at less risk by playing in the market than loaning money to you or I. So that's what's happening. So you find that in these particular banks, they don't have these aggressive loan officers out there trying to have us borrow money from them. They've got these very sophisticated investment departments that are taking that money and investing it in various commodities, various municipal bonds, whatever they may find that makes sense for them, that's not risky, but that'll return them the kind of investment on a yearly basis that makes some sense. So you're repaying them at 2 over prime, at 10%, 11%, and their investments are giving them, even if they give them the same amount. If they're in a mutual fund that's getting, or if they have, it's in corporate bonds of some sort, or if they're in municipal bonds, and they're receiving 12% or even the same amount, 10, 11%, there's much less risk in that than investing with you. So I've found that is the case, and again, it's very surprising that when you begin to go over portfolios of these banks and begin to see what they're doing with their funds, that's what they're doing. So again, where are we in that whole process? It seems that we're somewhat left out. Allied Capital, for example, Allied Capital is one of the largest venture capital firms in the Baltimore metropolitan area. And they have a lot of different divisions in Allied Capital, and one of them is an SSBIC and an SBIC, the Small Business Investment Corporation, and the Specialized Small Business Investment Corporation under the SBA program. And the SBA has said to these venture capital firms, and others said to them, look, we think it's important to invest in minority businesses. So here's what we're going to do for you. And I mentioned this a couple years ago. He said that if you do this under our guidelines, what I will do is I will match you $4 for every $1 you raise. You raise $1, I'll match it with $4, so you have $5. You do it with $1 million, you put in $1 million, I'll give you $4 million, you'll have $5 million. And the requirement is that you have to invest in minority businesses with that $5 million. SBIC says you have to invest in small businesses. Doesn't have to be minority, just small business. The SSBIC says you must invest in minority businesses, and we will help you by matching that 4-to-1. And so what these venture capital firms have done is they have set up SBICs and SSBIC because of the cost of money. And then the money is very, very cheap. The government takes the T-bill rate, and for an SSBIC, they reduce that by 2 points, and that's what you're paying. So if the T-bill rate is 5%, and they give you a 2-point deduction on that, then you're paying 3% for the money from SBA. And then they have a guidelines on which you can loan it out, and basically it's a certain number of points over that rate, but you basically have about somewhere near 11%. So you can get it in at 3 and loan it out at 11. And there are other requirements about how much investment you can make in the company so that you can't take a majority share of the. But that's a way that they're starting to go. The problem that I see with this is that those of you who were heard me a couple years ago remember that we were starting in a SSBIC. There was a group of venture capitalists that I know very well in the Baltimore area. They're the second largest venture capital firm. They now manage about a little over $200 million, and they're raising another fund too, which will be a $125 million fund. So then there'll be over $300 million under management. This is a majority firm, 5 individuals, specialized areas. And we have a minority business group. We just started meeting in the morning. There are 5 of us, 6 of us, African American. I'm the only Muslim in the group. And we said, it's important for us just to get together and talk about business and see what comes. So we kept talking about some things, and one of the things that we thought made sense was this. And this came because I'm close to one of the people in the venture capital firm, and so we said, why don't we put together an SSBIC? They can raise the funds. We understand the minority business community, and we can find those who need the funds. We can do the initial due diligence to make sure that, in fact, to do what we can. You never make sure that our investments are sound. So we started this process, and it's been a 2-year process. What they discovered, and they were so successful in going out and raising money from the business community, is as soon as they went to the same business community and said to them, we've got this idea, and we think it's a great idea. The need is there. We can get cheap money from SBA, and this seems like a real winner to us. And we can return to you your investment. We can return to you even a higher margin than we're returning on our other 4 funds. Except, but this fund is a minority fund. So it was called Growth Tech Minority Partners. It's a minority fund, meaning that we want to invest in minority businesses. And then the door slammed shut. And that's what shocked them. They said, wow, he said, this is a moneymaker. He said, we can't get money at these particular rates. He said, this is a moneymaker. Those folks who invest in our other funds, and they have 4 funds now, Fund 1, 2, 3, and 4, where they raise a certain amount of money in each fund, and they use that, and then they have another, this is the 4th. This would be the 5th fund. This is the winner. But once the business community saw that it was a minority fund, then everything clammed up. And it was very interesting because we were at some of the meetings when we made the presentations to some of the big pension funds, because that's where a lot of the money comes from, state pension funds, city pension funds, from major corporations that have funds, and they want that invested. You have teachers' funds, that the money that invested from there, and people who manage these huge funds. So I was at a couple of meetings, and we made the presentation, and they asked questions of us that they normally would not ask. What is our objective in this? Are we interested in making money? Because with them, it's making money. It's nothing else. Is this a social program? And are you doing, because what we found out, discovered, is that they feel if it's a minority, it's social. It's not business. That we have some objective that we're going to do great good for the African American community. And they're saying, that's fine if you want to do that. I give $100 a year to United Negro College Fund. That's where I do good. And other kind. We said, but when I invest my money, I invest that money to make a return. And it's just the perception of us that if we in fact are involved in it, it's a social program and it's not real serious money, and that we're not in it to make money. And so that's where we still are with this particular program. We're supposed to have a meeting in July because they're finished up raising this one fund. Once they discovered that, then they began to divert their attention to their 4th fund, and that should be raised and closed in July, and then we get back together to see where we are and see whether or not we can go forward with this. I tend to believe that there are sources of funds out there. They're accustomed to raising from a certain group. I believe there are other groups out there, and that there are funds that can be raised if the situation is set up properly, and if they believe that in fact we're serious about making money, because they're not going to invest unless that's it. They want to hear, what is your objective? And if it's anything other